Hello everyone, John AG here. I need you to lock in because what I'm about to show you is the kind of quiet market event that doesn't feel loud until it suddenly rewrites your entire financial reality. A few hours ago, while the financial media was doing what it always does, stock tickers, feel-good CEO clips, and the same recycled optimism, something snapped in Japan's bond market. And when I say snapped, I don't mean a rough day. I mean the type of rupture that usually gets labeled a normalization, right up until the moment people realize the door is already closing behind them. Now, quick note before we go deeper. My YouTube stats are wild. A huge chunk of people watching these videos haven't subscribed yet. So if you get value from what I break down here, hit subscribe right now and drop a quick comment like our John AG so the algorithm knows you're actually here with me. Alright, here's the big picture. Japan's government bond market is one of the load-bearing walls of global liquidity. Trillions of dollars of leverage, collateral, and safe assumptions sit on top of it. And today, the price action screamed one message. That wall is cracking. And here's the part most people still don't understand. When a G7 bond market starts behaving irrationally, it doesn't stay in that country. It spreads. It infects every other bond market. And then it spills into currencies, commodities, and yes, precious metals. So in this video, I'm going to do three things. First, I'm going to explain what actually happened in Japan and why the mainstream spin will miss the point. Second, I'm going to connect the dots between Japan's crisis and the US Treasury market, because that connection is where the real danger lives. And third, I'm going to tell you what I'm watching in silver right now, why the move is getting violent, and what could happen next if a few key levels break. Also, if you want daily updates, quick posts, extra charts, and my personal notes that I don't always put on YouTube, I created a WhatsApp channel for that. The link is in the description. Join it because when things move fast, WhatsApp is where I can update you instantly, including voice notes and rapid alerts. And one more quick thing. If you're into silver success stories, real people, real wins, and how different folks built wealth through silver, there's a separate channel linked in the description. Go subscribe over there too, because it's motivating to see what's possible when you play the long game. Now let's jump in. Here's the first thing most people miss. Japan didn't spend 3 decades teaching the world rates can stay low forever. Because Japan was magically disciplined. Japan did it because the entire system became dependent on low rates. When your government debt is measured in multiples of your economy, you don't have the luxury of paying market rates without consequences. Low rates aren't a policy preference anymore. They're a survival requirement. That's why the long end matters so much. 10-year yields get headlines, but the 30-year and 40-year are where the real stress shows up. Because those are the maturities that expose the we can roll this forever story. Japan's domestic institutions are loaded with this paper. Pensions, insurers, banks. They bought it when yields were tiny because they were promised stability. They were told it was safe, liquid, and essentially risk-free. And to be fair, for years it was stable because the central bank was the buyer of last resort. But when yields pop, those institutions don't just feel it in a theoretical way. They feel it on their balance sheets. Their bond prices fall, their capital ratios get squeezed, their risk teams start screaming. And once risk teams scream, the portfolio managers stop being artists and start being janitors. They clean up risk, they cut exposure, they sell what they can sell. Now here's the key. When everyone sells the same thing, at the same time, liquidity disappears. And liquidity disappearing is what a bond market event looks like before the mainstream calls it a crisis. You'll see it in the auctions. Let's talk about auctions for a second because this is where the market actually votes. An auction isn't a chart, it's a real-world test. Who will show up and lend money at this price? When an auction is strong, you see robust bidding and a comfortable cover ratio. When it's weak, you see dealers stuck holding inventory they don't want. And that's when you start to get a feedback loop because dealers hedge, they dump, yields jump, and the next auction becomes even harder. People forget that sovereign debt markets are confidence markets. Yes, there's math. But there's also belief. Investors have to believe the issuer can service the debt without detonating the currency. And the moment the market starts to doubt that, you can't talk your way out of it. Now, I can already hear the skeptics. Japan has done this before, they always manage it. Here's what's different. The world is not in a low inflation, low volatility, global growth sweet spot anymore. We're in a world where supply chains are politicized, energy is strategic, and governments are trying to spend their way through everything. That means inflation risk isn't dead, it's lurking. And in that world, bond buyers demand higher compensation. They demand yield, which is the one thing a debt-saturated government doesn't want to give. Now let's connect this to the US tongue, because this is where the domino effect gets real. Japan's reserves are not just a number on a sheet. They're part of how Japan manages its currency and its stability. If the yen weakens too fast, Japan has to decide whether to defend it. Defending a currency often means selling foreign assets to buy your own currency, foreign assets like treasuries. So Japan is squeezed. Defend bonds and risk the currency, or defend the currency and risk dumping treasuries. Either way, global yields feel it. And when US yields rise, you don't just get a bond story, you get a housing story, you get a corporate refinancing story, you get a government deficit story, because the US is also running massive deficits. And higher rates mean higher debt service. This is why I keep saying sovereign debt is not a spectator sport anymore. Now let's talk about the carry trade angle, because this is one of the quiet engines behind global asset pricing. For years, Japan's low rates were like a fuel station for global leverage. Borrow cheap in yen, invest in higher yielding assets elsewhere, pocket the spread. That's not a conspiracy, that's finance. But carry trades work until volatility hits and currencies move the wrong way. If Japanese yields rise and the yen moves violently, carry trades can unwind fast. And when carry trades unwind, selling doesn't stay in one asset class. It becomes broad. Stocks, credit, emerging markets, anything that was crowded on cheap funding can get hit. That's why today's bond move is more than a bond move. It's a funding move. And funding is everything. Now let's make this even more concrete. Imagine you're a Japanese insurer. You own a pile of JGBs because regulators and tradition told you it was prudent. You also own foreign bonds and maybe some equities to get yield. Now your JGBs are down. Your risk model says your portfolio is riskier than your limit. Your regulator is watching. Your clients are watching. Your board is watching. You need to reduce risk. You sell. But what do you sell first? Often you sell the most liquid things. And that can be foreign bonds again, like treasuries. This is why you can get a weird situation where a crisis in Japan pushes US yields higher. Even if US growth is slowing, because it's not about growth, it's about forced liquidation. Now let's bring silver back into this, because the way silver is behaving is not random. If silver were moving purely on industrial demand, it would be smoother. It would be a grind, not a snap. The snap tells you there's a monetary component. And the monetary component is confidence. When bond markets start signaling stress, people hunt for assets that are no one else's liability. Gold is the king of that category. Silver is the smaller cousin that moves more violently. And that violence is exactly why it grabs attention when the world gets nervous. Now let's address the paper versus physical problem in plain language. There's the price you see on the screen, and then there's the price you pay to actually take delivery of real metal. In calm times, those are close. In stressed times, they separate. Why? Because paper markets can create supply with a keystroke, a contract, a promise, a synthetic ounce. Physical markets cannot. Physical supply is mined, refined, fabricated, shipped, and stored. It has constraints. So when demand jumps, physical tightness shows up in premiums, delivery delays, and shrinking dealer inventory. The people who understand this don't wait for the headline. They act when the screen still looks normal. Now you might be thinking, okay, John, silver is up, but why are you talking about $100 like it's inevitable? Because $100 isn't just a number. It's a narrative pivot. It's a round number that changes behavior. At $98, people debate. Allows on people react, and reactions create feedback. Short sellers get nervous. Options dealers hedge. Momentum funds pay attention. Retail gets alerted. Headlines appear, and suddenly the market isn't trading fundamentals. It's trading psychology. That's how you get a squeeze. Now let's talk about squeezes. Honestly, squeezes don't happen because everyone agrees. They happen because positioning is wrong. If large players are short and price rises, they're forced to buy back. That buying pushes price higher, which forces more buying, and the loop feeds itself. Silver is especially sensitive to this because the paper market is huge relative to the physical market. You don't need all shorts to cover. You just need enough pressure at the wrong time. And when bond markets are unstable, pressure shows up. Now I want to bring in something that doesn't get enough attention. Collateral. Bonds are collateral for the financial system. They're used to secure borrowing. They're posted in repo. They're treated as safe. When bond prices fall and volatility rises, collateral quality gets questioned, haircuts rise, and borrowing becomes more expensive. That's how liquidity vanishes. And when liquidity vanishes, people sell what they can, not what they want. That's why you can see bizarre correlations. Gold up, stocks down, bonds down, then everything flips the next day. It's not stable because the system is scrambling. Now, if you're still with me, here's the cliffhanger inside the cliffhanger. What happens if Japan's central bank tries to cap yields and fails? That's the moment where the market starts believing central banks are not omnipotent. And when that belief spreads, the fight changes. It becomes a trust crisis. Now I want to slow down and walk you through the 3 outcomes framework because it helps you think clearly when headlines are chaotic. Outcome 1. Japan stabilizes yields through aggressive buying and the yen stays relatively stable. This is the soft landing narrative. It requires perfect timing, perfect communication, and a market that still believes. Outcome 2. Japan stabilizes yields, but the yen weakens sharply. That's the bond market saved, currency stressed outcome. It tends to be bullish for gold and silver because the currency signal screams debasement. Outcome 3. Japan fails to stabilize yields and the long end runs. That's the market revolt outcome. It can trigger forced selling across assets and create emergency interventions worldwide. In all 3 outcomes, the common thread is this: faith in paper promises weakens, and when faith weakens, hard assets strengthen. Now I want to add another layer that will matter for retention over the next months. Demographics and domestic buyers. Japan has an aging population. That means a bigger share of the population is living off savings, pensions, and fixed income. Rising yields might sound good for them until you realize rising yields crush the value of the bond portfolios they already own. This is why the transition is so painful. You can't just reset rates without destroying legacy balance sheets. And Japan is the first major country to face this at scale. Now let's bring this back to silver fundamentals for a moment, because yes, macro drives the wave, but fundamentals shape the shoreline. Industrial demand is not a rumor. It's real. Silver is used in high-efficiency electronics and solar components. The demand doesn't stop because the bond market is nervous, and supply isn't instantly flexible. Mines don't double output because price jumped 10% this week. Projects take years, permits take years, capital takes years. So when investment demand collides with industrial demand, the market tightens quickly. Now some people will say, but if silver gets too expensive, industry will substitute sometimes. But substitution has limits. Performance matters, reliability matters. In many applications, silver's properties are hard to replace without trade-offs. And even if substitution happens, it's not instant. So the short-term dynamic can still be violent. Now, I want to make a practical point that most channels avoid because it's not glamorous. If you're stacking physical, don't wait for the perfect day. The perfect day is when everyone else is buying. That's when inventory is thin, shipping is slow, and premiums are high. The boring days are when you build. And today's bond signal tells me the boring days are not going to last forever. Now, this is also why I created that WhatsApp channel. Markets don't schedule their drama around your free time. When things shift, you want the update quickly. Link is in the description. Join it. All right, let's talk about the US side again, because I want you to understand what US long yields pressing into big levels really means. The US long bond is a benchmark for long-term borrowing. Mortgage rates tend to track it. Corporate debt pricing leans on it. Discount rates for equities lean on it. When the long bond rises, it squeezes everything that was priced for low rates. And after years of low rates, that's basically everything. So, if you're watching the bond market and thinking that's for professionals, you're missing the point. Bond markets are where the cost of money is set. And the cost of money sets the price of everything else. Now here's a subtle but important thing. When rates rise because growth is strong, the system can sometimes handle it. When rates rise because bond buyers demand compensation for risk, the system struggles. Today felt more like compensation for risk than celebration of growth. That distinction matters. Now, I want to anticipate the central bank will fix it counter-argument. Yes, central banks can buy bonds. But every time a central bank buys bonds to cap yields, it's increasing the money supply and signaling that rates cannot rise naturally. That's a form of yield control. And yield control tends to be bullish for hard assets because it tells the market inflation will be tolerated rather than default. If authorities have to cap yields, it's not a victory. It's an admission. Now, let me bring in an example from recent history without getting trapped in nostalgia. When central banks intervene aggressively, markets can calm temporarily. But the cost is that imbalances grow. The longer you suppress signals, the bigger the eventual move when the signal breaks free. Japan has suppressed signals for decades. So if the signal is breaking now, it's not going to be a polite adjustment. It's going to be messy. Now I want to talk about the most dangerous misunderstanding I see in the comments. Sometimes people think a crisis is a single day. It's not. A crisis is a process. First, a market breaks, then authorities respond. Then markets react to the response, then authorities respond again. And each cycle weakens confidence a little more. That's why I keep pushing the idea of a dashboard. Don't get hypnotized by one headline. Track the levels. Track the reaction function. Track whether interventions work. Now, speaking of dashboards, here are a few extra indicators I'm watching besides the obvious. I watch how quickly yields mean revert after spikes. If spikes persist, it signals deeper stress. I watch currency volatility. If the yen starts making sharp moves, it tells you the system is losing balance. I watch credit spreads. If corporate credit starts widening, it means the bond stress is moving into real financing stress. I watch the gold-silver ratio. When silver outperforms, it often signals speculative monetary fear. And I watch physical premiums. When premiums widen while paper price chops, it tells you real demand is underneath. Now, I want to be direct about something. I'm running a campaign to push back against copycat content. If you value original analysis and you want to support me while we eliminate the copycats, the simplest thing you can do is subscribe and leave a comment. Again, even our John AG works. That small action helps more than you realize. Now here's the part where I want to get personal for a second. I've watched cycles where people laughed at metals, then begged for them. I've watched cycles where safe assets weren't safe. And what always shocks me is how quickly sentiment flips once the crowd realizes the rules changed. That's why I'm not waiting for permission from the media to take this seriously. I'm watching the yield curve and the behavior. Behavior is truth. Now let's explore two scenario paths for silver from here, because this is what everyone wants to know. Scenario A, silver breaks higher, runs through the round number, squeezes, then pulls back hard. That's a classic blow-off dynamic. Scenario B, silver breaks higher, consolidates above the round number, and then grinds upward in waves as capital rotates from bonds into hard assets. Both scenarios can happen. The difference is the bond market. If bond stress keeps escalating, B becomes more likely. If bond stress stabilizes for a moment, A becomes more likely. Now, what would tell me scenario A is happening? You'd see huge daily ranges. You'd see too fast chatter everywhere. You'd see margin hikes. You'd see sudden intraday reversals. And what would tell me scenario B is happening? You'd see price hold above key levels despite pullbacks. You'd see steady accumulation. You'd see persistent premiums. You'd see the gold-silver ratio trending down as silver holds leadership. Now I want to give you two quick questions and I want you to answer them in the comments. First, do you think Japan can actually stabilize their long end without torching the yen? Second, if silver clears the next big round number, do you think it stops there or do you think it forces a squeeze? Drop your answers below. I read the comments and your ideas influence what I cover next. Now, another cliffhanger. If Japan sells foreign reserves and the US responds with a stronger backstop, what happens to the dollar narrative? Some people think the dollar will always win because it's the reserve. Reserve status is powerful. Yes, but reserve status doesn't protect you from debasement. It can even tempt more debasement because demand allows you to stretch the system longer. And the longer you stretch it, the sharper the snap if confidence breaks. That's why I'm watching hard assets, not just currencies. Now I also want to address the equities are the safe place idea. In the early stage of a bond shock, equities can hold up, especially if people believe policymakers will rescue everything. But if yields keep rising, equities eventually feel it through discount rates and refinancing. That's why the run from bonds into stocks trade can become a trap if the bond move is driven by risk premiums, not growth. So again, I come back to the idea of owning something that doesn't require another person's promise. Now I'm going to weave in a viewer-style moment like I do in other videos. I've had people ask me, if this is so serious, why isn't everyone talking about it? And the answer is simple. Most people talk about what already happened. They don't talk about what is forming. It's easier to comment on a move after it's on the front page than it is to explain a mechanism while it's building. But your advantage is being early to understanding. Not early to panic, early to clarity. Now, another question I've seen, should I only buy silver or should I consider gold too? I'm not telling you what to do, but conceptually gold is stability, silver is leverage. Gold often moves first, silver often moves harder later, and in a world where confidence and debt weakens, both can have a role. Okay, let's bring it home with a tighter look at the emotional side because it's not just charts, it's what people feel. When bond markets wobble, most people don't feel it immediately. Then a headline hits, borrowing costs jump. Then a headline hits, pensions face losses. Then a headline hits, emergency meeting. And suddenly people realize this isn't a chart on a screen. It's their life. The earlier you understand the sequence, the calmer you can be while others are panicking. That's the goal. Now here's another engagement moment. If you've ever lived through a period where inflation or currency weakness changed your life, Whether it was in your country or in your family, share a short story in the comments. It helps people here understand that these aren't academic topics. Pay attention to how authorities frame their actions. If they say they're ensuring market functioning, it often means liquidity is fading. If they say they're monitoring volatility, it often means volatility is rising. And if they say they're ready to act, it often means they're already behind. Words are lagging indicators. Yields are leading indicators. Japan's long end moved in a way that suggests stress, not normalization. That stress triggers risk models and forced selling. Forced selling can spill into global bonds through reserves, hedges, and carry trade unwinds. Rising global yields tighten financing and expose debt loads. Hard assets respond as confidence in paper weakens. And silver, because it's smaller and more emotional, can move faster and more violently than most people expect. Now, I want you to understand what I mean when I say a bond market stops functioning like a rational market, because that sounds dramatic until you see the mechanics. A functioning bond market is boring. Quotes are tight. Dealers make markets. If you want to sell, you can sell without blowing the price apart. Auctions clear with predictable demand. Everyone might complain about yields, but the machine runs. A stressed bond market starts to do strange things. Bid-ask spreads widen. Liquidity becomes selective. You get pockets where nothing trades unless you take a terrible price. Most importantly, you get moments where price is no longer set by fair value. It's set by whoever is forced to move first. That's what forced selling does. It turns markets into pressure cookers. And in sovereign bonds, this matters more than almost anywhere else because sovereign bonds are the collateral underneath everything. They're the thing banks post and repo. They're what insurers use to prove they're solvent. They're what pension funds lean on to match liabilities. They're the safe thing. So when sovereign bonds get volatile, you're not just repricing a bond, you're repricing trust. This is also why the phrase bond vigilantes is back in the conversation. Bond vigilantes are simply investors who refuse to fund governments at artificial prices. They demand compensation for inflation risk, fiscal risk, and currency risk. They don't carry signs, they don't chant, they sell. And when they sell, they raise yields. Now here's the uncomfortable part. Governments can fight bond vigilantes, but the fight always costs something. They can raise taxes, they can cut spending, they can inflate. They can default through inflation. They can do yield control. But they can't pretend the debt doesn't exist. Japan's debt exists, and the longer the debt exists at high levels, the more the system depends on low rates. That is the trap. Now let's talk about the hidden stress point most people miss. Duration. Long bonds have high duration, meaning they are extremely sensitive to rate changes. A small move in yield can cause a big move in price. When yields jump, long bond prices drop hard. That means the losses show up first and hardest in the long end. So when you see the long end going wild, it's not random. It's the stress test showing you where the system is weakest. Now, I'm not asking you to memorize bond math. I'm asking you to notice where the panic goes first. And today, the panic went to the long end. Now, another reason this becomes contagious is that modern finance is built on marking assets to market. If you're a fund or an institution and your bond prices are falling, your reported value falls. If your reported value falls, your risk capacity falls. If your risk capacity falls, you have to reduce positions. That's why this isn't just Japan. This is how a local stress becomes a global deleveraging. Now you might ask, okay, but aren't Japanese bonds mostly held domestically? Doesn't that contain it? Domestic holding helps, but it doesn't immunize because even domestic holders face losses. And domestic holders also own foreign assets. They hedge, they rebalance, they shift, and the moment they shift, the shock leaks out. Now, let me connect this to a very specific mechanism: foreign exchange hedging. A lot of Japanese institutions that buy foreign bonds hedge the currency exposure. They use FX swaps and forwards to reduce yen risk. When volatility rises, hedging costs can rise. When hedging costs rise, foreign assets become less attractive. When foreign assets become less attractive, institutions reduce them. That reduction can mean selling treasuries. So you can get US yields rising not because America is suddenly stronger, but because hedged foreign demand is collapsing. This is the kind of nuance that gets lost on TV. Now, why does this matter for silver? Because silver doesn't care whether yields rose for good reasons or bad reasons. Silver responds to the consequences: confidence, liquidity, and currency purchasing power. If global yields rise and authorities respond with intervention, that often means more money creation. More money creation means currency dilution. Currency dilution supports the case for hard assets. Now, the part that feels counterintuitive is that in the early phase, you can sometimes see both. Yields rise and the currency strengthens temporarily. That happens when global investors scramble for liquidity and repay currency debts. But if authorities later cap yields with printing, the currency can weaken. This is why the timeline matters. A short-term liquidity panic can make everything weird. Long-term monetary response tends to favor hard assets, and silver sits right on that fault line. Now, I want to talk about the silver market structure a bit more because it's the difference between price went up and price can't go down easily. The paper market is dominated by futures, options, and large financial flows. It's fast, it's liquid. It can whip around violently. The physical market is slower. It's dealers, refiners, mints, vaults, industrial buyers, and long-term holders. It doesn't turn on a dime. So when the paper market spikes, physical has to catch up. When physical tightens, paper can be forced to follow. And the giveaway that physical is tight, it's not a single-day price move. It's persistent premiums, persistent delivery delays, and persistent stories of we're out of stock. If you're seeing that while silver is ripping, that's not a normal rally. That's a market trying to find the price that clears real demand. Now I'll give you a simple way to think about it. If the spot price is the headline, the premium is the body language. And lately, the body language has been tense. Now another lever is industrial procurement. Industrial buyers don't like volatility. They prefer predictable input costs, but they can't shut down a production line because silver got expensive for a week. So what do? They hedge. They secure supply. They pre-buy. That behavior can remove metal from the market right when investors are also buying, and that's how you get supply stress. Now let's add in the psychology of retail. Retail investors tend to show up late, but when they show up emotionally. They remember missing other moves. They hear new highs. They feel urgency. And when retail shows up in a market with limited physical float, premiums can spike quickly. So if you've ever wondered why spot and your checkout price can diverge, that's why. Now to keep this grounded, I want to tell you what would make me relax about this whole Japan Treasury silver chain. It's simple. I would need to see yields retreat and stay calm without massive central bank force. If Japan's long end comes down because the market organically believes the fiscal math is stable and auctions clear smoothly and volatility fades, that would lower the urgency. But if yields only come down because authorities come in with a bazooka, that's not calming. That's a different signal. That signal says the market won, and the central bank is printing to patch the crack. That signal is bullish for hard assets over time. Now let me answer two viewer-style questions that keep popping up because I know people are thinking them even if they don't type them. Clears throat. Question 1. Isn't silver already too high? Aren't we late? The honest answer is it depends on the time frame. If you're trying to day trade, late is a real risk. Volatility can rip your face off. If you're trying to protect purchasing power over years, high is often an illusion created by currency debasement. The currency is what's getting weaker. The metal is what's staying metal. Question 2, what about mining stocks? Aren't they the leverage play? Mining stocks can be leveraged, but they come with business risk, operational risk, and market risk. In a liquidity shock, even good miners can get sold because funds need cash. That's why for the role of system hedge, physical metal has a unique property. It's not someone else's promise. Now, I'm not anti-stocks, I'm not anti-everything. I'm saying know what you own and know why you own it. Now let me add a retention critical point. The next phase of this story may not be a straight line. People love straight lines, markets don't. You can get days where yields spike, silver spikes, then everything pulls back because someone announces a meeting or an intervention. Then you can get a week of calm, and then you can get another spike. That's why this is a process. And if you're emotionally unprepared for chop, you can make the worst decisions at the worst moments. So my advice on mindset, again, not financial advice, just mindset, is don't let one red day or one green day rewrite your thesis. Watch the system. Watch the repeated behavior. Now, I want to reinforce the 1S sentence truth that ties everything together. Debt at scale requires low rates, and low rates require belief. If belief breaks, rates rise. If rates rise, debt service stress rises. If debt service stress rises, authorities print or default in real terms. Printing supports hard assets. That's the cycle. Now, quick mid-vide reminder because I don't want you to forget. If you're still watching right now, that tells me you care about understanding, not just headlines. So do me a favor, subscribe and type ArjgonAG in the comments. It helps my campaign against copycats, and it tells the algorithm to push this to people who actually need it. And if you want the faster updates, again, WhatsApp link is in the description. Now I also promised I'd keep this engaging with Cliffers. So here's the next one. What happens when the bond market forces politicians to choose between austerity and inflation? Because that choice isn't theoretical, it's coming. Austerity means cutting benefits, cutting spending, and raising taxes. That's unpopular. Inflation means printing, devaluing, and quietly taking purchasing power. That's also unpopular, but it's often chosen because it's less immediate. And when inflation is chosen, metals tend to respond. Now, one more practical thing about silver. The market is small enough that flows matter. A modest reallocation from bond funds into metals can create disproportionate moves because the size of global bond markets is enormous compared to the size of the silver market. So when people say, why would silver move so much? The answer is because it doesn't take much capital to move a small market when supply is tight. Now let's talk about why the mainstream might try to scare you out of metals right when the story is improving for metals. They'll say it's a bubble. They'll say it's overbought. They'll talk about margin hikes like it's proof the rally is fake when margin hikes are often proof the rally is stressing the shorts. They'll focus on daily charts to make you forget the multi-year cycle. This is why you have to decide what game you're playing. If you're playing the daily game, the daily news will whip you. If you're playing the purchasing power game, the daily news is just noise. Now I want to end this with something simple and human. If you're successful, if you've built something, saved consistently, or navigated hard times, share that in the comments once again, even briefly. People watching this are not just traders. They're families. They're workers. They're people trying to keep up in a world that keeps changing. And if you're struggling, know you're not alone. The system is built to confuse and exhaust you. But understanding is power. And that's why we're here. Before you go, reminder today. By the time you're watching this, a Member Sunly update video should already be live, bundling the latest bond and silver developments in one place. Join the membership and watch it if you want the deeper no-fluff breakdowns. And if you want daily posts, voice notes, and alerts, join the WhatsApp channel in the description. If this helped, subscribe, hit like, and answer the 2 questions I asked earlier in the comments. Even a quick Johnny G helps this message beat the copycats. Take care of yourselves and take care of each.